Hey, it's Soleil, and this is episode 110 of the Orange Pill Investor. And today I want to talk about MicroStrategy and Ivy Crush. So, the groups that I'm in have a lot of interest in earnings today. And I guess we're pretty hopeful that FASB fair value accounting rules will get put into place. And so, if, and it's always a big if in the stock market, if there's a large gap up, how could one place a trade today to take advantage of that? Obviously, if you buy the shares and the price goes up, the price went up. Uh, However, in options, there are some things that can look enticing, but can be very dangerous the day before earnings, and it's called IV Crush. So if you're even barely familiar with options, you should understand that implied volatility is a function of the options price. When options prices are becoming more and more expensive, the implied volatility is high. And I used to just be a complete implied volatility hunter. And so I used to go to Market Chameleon and I would filter for implied volatility rankings, and then I would just sort by whatever had the highest IV. I would go out IV 30 or maybe even IV 30 over 52 weeks, and then I would try to find the companies that had the highest volatility, and then I would sell covered calls against them if the premium was also high. There's a weird thing that sometimes the implied volatility for a particular stock does not drive the exact same option premium as another stock with the exact same implied volatility. That the reason for that is not completely clear to me, but there are definitely some other factors that are driving the actual options price for that particular stock. Now you can see, so what is before I get into some of this other stuff, what is IV Crush? So let's just take a look at Tesla, because Tesla just had earnings, and this chart is a very good indicator. This was earnings. Implied volatility, this was probably like a price pump or something, but implied volatility, was down here, and right before earnings it finishes here. Implied volatility was 56 and just, plummeted to 40, because now that the earnings is known, the anxiety about what earnings is going to be is over. So implied volatility collapses. This one really not much, dropped from 51, next day 48. So there was not a whole lot of IV Crush here. But here's another good example. It was 52, next day 44. This one was a big one. It was 62 and dropped to 45. Now, can that be a problem? I'm just going to jump over to the MicroStrategy chart instead. So in this case, implied volatility is 116. And Vega, I almost never look at Vega because I really don't buy options before earnings because of IV Crush. And what's going to happen here is if implied volatility were to go up to, let's just say it goes up 10 to 126, then the price of this option would go up by half of that. So 10 times 0.5, this would go up $5. However, in the case of earnings, implied volatility collapses. And so MicroStrategy's chart does not really look like Tesla's, though. So there's not a lot of IV Crush here. This was earnings, right after earnings, maybe a little. Dropped 4 points. Here it didn't go down at all, really. And then shortly going up. So right now, this is us for MicroStrategy. And because we had this huge spike, so earnings is not the only thing that kind of screws with implied volatility. So in general, implied volatility right after earnings is crushed, and then it builds in crescendo to earnings again, because there's no earnings anticipation here, and then oh shit, what's going to happen, oh, earnings, okay, crush. That doesn't really seem to be happening with MicroStrategy. This was a giant price pump. So this is when MicroStrategy went from like 500 to 1,000 to 1,800 to 2,000 or whatever within a couple of weeks. But let's just say that you're feeling froggy and you're like, let me just buy this at the money options call for this Friday. Well, Vega is 0.54. If MicroStrategy does suffer from earnings crush and drops back down to its normal level of around 65, and IV right now is 115, that's a 50-point drop. So I hope you can see where I'm going with this. So you think that 50-point drop times, basically, I'm just going to use 0.5 for easy math. That means that the price of this option overnight, whether MicroStrategy's price changes at all or not, is going to drop by half of 50, so 25. You would lose $2,500 in value on this option, even if we wake up tomorrow and the price is $12.60. If the implied volatility drops, because now the cat's out of the bag, earnings has been released, there's no more anticipation. If that happens, the value of this drops by $2,500, which means that you need delta to kick in. Not only, you know, if this didn't exist at all you would need was for the price to go up from, you know, $12.60 to, let's just say $100 up. You know, $100 would move this because of delta is 0.54, would move the price of the stock half a buck for every dollar in the move. So you'd need, so if the price on MicroStrategy went up from $12.60 to $13.60, you'd get $50 in profit. So you actually need an extra, you know, you're going to need an extra dollar move on the price for every dollar lost because of implied volatility, IV crush. So that's the danger in buying options right before earnings, is you can be directionally correct. Like if you're only directionally correct, like $25, then the price of your stock's only going to go up $12, and you lost $25 because of Vega risk. So in general principle, I never, ever buy options before earnings. It's not only is it just kind of like scratching a lottery ticket, it's a built-in, there's a, you know, built-in VIG against you. So it's not terribly bright. So if you're determined to do it, and I may be determined to do it as well, how would you avoid IV crush? Now, the good thing about, well, actually, so here's the other problem with MicroStrategy. The liquidity on the stock is not bad, but the liquidity on the options is not great. So there's 72 bids right now at 67. There's 50 asks at 75. That's that's like $6-7 bid-ask spread. So you're gonna get fucked in the ask by trying to figure out, you know, can I get the mark price filled? And if you're trying to buy, you're probably going to end up having to go above the mark price to get this filled. I'm not promising anything, not financial advice, but so number one, do I normally never buy options before earnings? But I try not to buy options in anything that's not very liquid. Now, I do own MicroStrategy, and I sell covered calls against this every week. So, I mean, a $5, $6, $7 bid-ask spread, you're going to get a fill somewhere in the middle. But when options are so expensive, you can kind of afford a little bit of leeway in an illiquid options trade. And so, anyway, how do you make Vega smaller? One way you can make Vega smaller is to go way up the chain. So I've already been looking at this. So if you go all the way up to the 1700 strike, Vega is now 0.1 instead of 0.5. Now the implied volatility is also different for every single leg. So we were looking at a 116 implied volatility at the money, but implied volatility way the hell up here is in frickin' no man's land is now 140. But if we get a similar drop, if we get a 50-point drop from here, or maybe even a 70-point drop, because it has farther to fall, there's no telling where the hell this could go. But let's just say another 50-point drop. You multiply that 50 times 0.1, and this changes $5. Well, if this goes down $5, that's already zero. You're only paying $2.50. Now, and the reason I went for 1700 is because once you get up here, the liquidity that I was talking about gets even worse. So this one at least is in the realm of, because it's a nice whole number. This is the highest strike that I could find that was still like, had even a shred of pretending to be liquid. If you go to the 1705, the bid-ask spread on a $2 option is $3. The frickin' bid-ask spread is greater than the value of the stock. I would avoid shit like this like the plague. 1800 is a nice whole number as well, but the bid-ask spread is 30 cents, which isn't terrible. Open interest and volumes, it's not great, but it's not like the worst. So was it 30-cent bid-ask spread here, and 1700 was like a 40-cent bid-ask spread. Okay, so it's possible to go to the 1800, and now that the market's been open a while, maybe this is opening up again. Let me just check the 1900. Yeah, see, 70-cent bid-ask spread, and the price is 70 cents. This is horrible. Because with options, and especially this is this Friday, the way that you profit from these things, you're not gonna exercise this damn thing. If the value of this goes to 1800, by expiration, this is basically just worthless. So the point of buying an option is to sell the option. You're almost never going to exercise, and the reason you're never going to exercise is because anything that still has some time remaining has some extrinsic value, and when you exercise it, you sacrifice all of the extrinsic value, all of the value that's built into the time. So all of this money that's draining out of theta every day, you're sacrificing theta times however many days are left. So exercising is almost never the right thing to do. It can be, like if the price of MicroStrategy went to 3,000 or something ridiculous, and no one would buy your option, or no one would buy it back from you. So you've got this option that's worth a shitload of money, but nobody wants it. If you can't get a fill, then you can't get out of it. And if you can't get out of it, you can't collect your profits, so you might as well exercise at that point. But if you exercise it, you got to have $180,000 to buy them. So I mean, this is a 5K account. So everyone who doesn't have $180,000 laying around isn't going to be able to even exercise this damn thing. So bid-ask spread is critical for getting in and getting out of options trades. So that being said, I'm probably going to place this trade anyway. And I'm a little bit pissed off because while I was making this video, I think the price went back up from $12.50 to $12.80. It's probably got a little more expensive. But, okay, but see, here's the other thing. So I'm worried about, initially I said I'm worried about implied volatility dropping from whatever this is, 115 to 65 tomorrow, and Vega just ruining my day. By going up the chain, we are eliminating 75, 80% of the Vega risk. However, if double, triple, quintuple, big, giant fucking if the price does surge to 1700 tomorrow or before expiration, now the at the money 0.5 Vega is now probably going to be closer to this Vega, because now you're at the money. So now Vega's back up to 0.5. Now that kind of could be a good thing, because earnings crush is not the only thing that can move the needle on implied volatility. So when MicroStrategy pumped last time from whatever the hell it was, MSTR, when it pumped, it was at 680. Not long after that, it had doubled. Not long after that, it had tripled. So large price moves up or down, especially down, can rocket the implied volatility of a stock. So earnings crush could maybe drop this by 50%, but if there's a sharp move upward, it could pump implied volatility back right up to here, and then it might not matter if Vega is back up to 0.5, because implied volatility didn't go down. Hell, it might even go up. Last time we had that price move, yeah, implied volatility doubled. So if MicroStrategy goes to 2,000, is it possible that there's earnings crush and the implied volatility goes down 50, but then it goes up 100 and actually goes up 50? In that case, you would benefit from an increase in Vega, but that's it. Really, the price really has to work hard in order to compensate for IV crush. I don't know if I can say that 100 fucking times in this video, but you can avoid all of this shit by just buying shares of the stock. A share of a stock has a delta of 1. None of these Greeks matter. And so here's the other thing that's going to change if the price goes from 1,200 to 1,700. Delta is going to go way up, and because of gamma, and gamma is the rate of change of delta, and so way the hell up here in the nosebleed section on the options chain, a change in the price of the stock moving $1 is going to move the price of this option 3 frickin' cents. $1 times 0.03, it's going to move this up to $2.53. Big whoop. However, let's go back down to the at the money again. So down here, delta goes up half a buck every time, but gamma is also higher. So as the price of MicroStrategy goes up $1, this goes up 50 cents, but then gamma increases delta by 0.0025. And so as the price of MicroStrategy would go up or down, delta is going to change. So, once, if MicroStrategy does actually shoot up to $2,000, now this looks like it's a deep in the money call. And so you're going to actually start getting 95-cent moves for every move in $1. But, gamma is way down here because there's really not much left for delta to move. So gamma is kind of shrinking here. But so yeah, I mean, I'm probably going to YOLO something for this. It's not going to be the end of the world. I'm going to keep the position size small enough that, I mean, hell, let's just do it. This is the main account. So for the 1700 strike, the delta on this is probably like probably like 2 or something. Or sorry, 0.2. This will cost me like, oh, and the the reason I even have any buying power is the Tesla god smiled on me today, and I was basically break even on these leaps yesterday, and they're up like $2,000 a piece. So I sold a couple of these off and got some buying power freed up. But oh shit, I just switched it. MicroStrategy. This is not financial advice. This is just scratching a lottery ticket. This money will probably evaporate tomorrow. And really, even there's like some accounting. Yellen's got some kind of accounting shit that she's going to release on Tuesday, and the market could either pump or tank based on Tuesday's news as well. So there's a lot of shit going on other than just MicroStrategy's earnings. I think Bitcoin is down, so that can fuck with MicroStrategy. But let's just, for the hell of it, I'm going to try to get like 10 of these. Again, this is probably a terrible idea. Let's see if I can not pay the full. Let's try to get it for 246. Huh, that actually filled a little too fast for my taste. I might have overpaid for those. So my trade price was 246, which is not too much over. Well, what was the bid-ask spread on this damn thing? Yeah, it was like 20 cents, 255. So that wasn't terrible. I did actually get this fill at the mid price. So again, this is some stupid YOLO shit. Everything about options fundamentals says not to do it. However, by going way the hell up here, I was able to shrink Vega. So like, this is probably a bad idea, but this is like the least bad idea. Now, I will also be buying some shares today, and with whatever buying power I have left over, around 350 today, I will be buying some of the last what I hope to be the last pre-FASB shares that will ever be sold. So hoping that MicroStrategy does fair market value reporting, hoping, lots of hopium here, but hoping there's, a nice pump on the stock. And, I actually am kind of grateful for this little bit of margin breathing room. So I will probably buy precious few shares today. It almost seems criminal to spend less than I spent on these stupid ass options. But, I may just buy like one share or something. Just almost kind of like for, I know some other folks will be snatching up some shares right before the close as well, almost kind of like, just sentimental value and just kind of a little fun thing to do, grab some pre-FASB shares, almost like, rare sats or something in the Bitcoin community. You got to get those rare sats. And, so I will grab at least one ceremonial share right before the close today. Looking forward to that. But anyway, that's it for now. If you're interested in tracking implied volatility, Market Chameleon is a great tool to do that. You can track and see how a particular stock reacts to implied volatility in relation to earnings. And generally what I would do is I would sell either cash secured puts or calls. I don't like selling naked calls, but if you sell two of those together, it's called a strangle. It's a it's not a defined risk trade by any means, but you can turn them into credit spreads, and you can do iron condors. So that's a credit spread at the bottom and a credit spread at the top, which will eliminate your infinite risk on the upside and downside. I used to sell iron condors right before earnings quite a bit. Made a little bit of money with it, but the time it took to deal with it and set up all of the trades and then try to monitor the trades in the morning, it just stopped being kind of worth my time. I may get back into it again just for fun, but this would be a decent chart to sell iron condors against, because you want to see IV crush. MicroStrategy would probably be a terrible, I would avoid this chart like a plague, selling iron condors, because I need IV crush to happen. Instead of what I've been discussing today, where IV crush is your enemy when you're buying options, when you're selling options right before earnings, that's what you absolutely want. You want to sell an option for, let's just say, $500. IV crush happens, and the value of that option drops in half, and now you can buy it back for $250, pocket the other half. Now, you also have to be directionally somewhat correct. Like, if there's a huge price move, you end up losing the whole 500. But that's the principle of it. So earnings IV crush is your friend if you're an option seller. IV crush is your enemy if you're an option purchaser. And I don't recommend anything to anyone, but even to myself. If I was giving myself advice, I would tell me not to do what I just did. But this is basically just scratching a lottery ticket, and it's just kind of fun. That's really the bottom line. This trade that I made does not make any logical sense, and actually I'll be sure to make sure to do another video about it to see what happened to the value, and see if IV did crash from implied volatility is 140. So let's just get that in the books. And if IV tomorrow is 70, we'll see if the value of my option collapsed from what I paid at 246. We'll see if the value collapsed to $1.25. So even if I do lose $2,000 on this trade, it will in some ways be worth it just for the scientific experiment and having something to record a video about tomorrow. We can all point and laugh at my dumbass doing dumb shit. All right, that's about it for now. Be good, y'all.